Welcome to Everything Life and Real Estate. Let's get started with our hosts, Linda McKissick and Dana Gentry.
Hi, everyone. Welcome to Everything Life and Real Estate. I'm Linda McKissick.
And I'm Dana Gentry.
Hey, Dana, I'm super excited. We are all, I don't know, I'm not, but Carrie, our CFO, is super busy in tax time. And I'm sure every realtor out there is thinking about, oh, crap, did I put any money away for taxes? So today on our show, we have a great longtime friend of mine, Chris Bird, who has helped realtors forever, as long as I can think of, 30 plus years, I think. His wife's in the business, and he's going to tell us his story here in just a second. But Chris is somebody that we always go to if we have a real estate tax question. So, Mr. Chris Bird, welcome to Everything Life in Real Estate. And tell us a little bit about you and how'd you wind up with a bunch of realtors? God bless you.
Well, thank you, Linda and Dana and Kate. Well, first of all, I'm from Champaign, Urbana, Illinois, about 3 hours south of Chicago. But started this whole thing as an IRS agent right out of college in the St. Louis and East St. Louis area. And I was an IRS agent doing primarily fraud work for a 16-year career. Left the IRS, started a speaking career and accounting practice long time ago. And I'm on the road about 100 days a year speaking to a combination of real estate groups as well as accounting and attorney groups. And right now it's the real estate side of it. I was in Minnesota earlier this week. I'll be in Nebraska next week, all conventions, things like that. But I specialize in dealing with real estate tax issues on the federal tax return. So, we're going to talk about what I think are the 10 biggest current issues in real estate right now from a federal tax standpoint, and some other things that Linda will take us into. But I've got a slide up that goes through the 10 points, and I'll do these in any order you want me to do, Linda, but I know you want to talk about cost segregation studies, which is number 4 on my list. So, Linda, as the moderator, I'm going to turn it back to you and just ask you what you want to do and just what sequence. Go ahead.
You know what? Let's just go down the list. They all look great,
Yeah.
like great things we need to know. So let's just go down the list. Top it from
Very
start to
good.
the bottom.
So you can see the 10, and number 1 is Congress in the last 7 or 8 years has really drilled deep into the tax code to allow individuals and corporations and partnerships, LLCs, things like that, who buy depreciable property to basically elect to either depreciate it over a period of time or to write it off very quickly. So it's a combination of Section 179, which is otherwise known as the expensing election, and or bonus depreciation, which is another facet of taking the entire cost off first. And what they've done, Linda, is they've really looked at residential rental property and commercial real estate, and basically allowed the people or the corporations that pay the money to put these things in, like appliances and carpeting and drapes and leasehold improvements, things like that, to make a choice between writing it all off in the first year or depreciating over a period of time. And one of my points here is that income tax rates are fairly low right now. And under the Biden administration, and I mean no criticism by that, just an observation, they want to take tax rates up again because they think that a lot of people making higher levels of income should pay more tax. But number 1 is quite good in the residential rental arena and the commercial arena as well. Number 2 is the Qualified Business Income Deduction, which came about in the Tax Cut and Jobs Act of 2017, first effective in 18, and is good through 2025. And your CPA or enrolled agent, whoever does your tax return, their tax software automatically computes this 20% qualified business income deduction. And literally it's 20% of your profit. But the planning side of this, and I'm a big believer in the S corporation, which is number 5 on my list, because for you higher income realtors and really any higher income self-employed person as well, If you are a sole proprietor paying no wages, all right, and you have a lot of profit from your business, you may basically phase yourself out of this qualified business income deduction. Whereas if you were an S corporation paying yourself a reasonable wage, you would get a lot of this qualified business income deduction. So for a lot of people, it's just a natural deduction. It comes automatically in the software. But for higher incomes, and I'm talking about people making 3, 4, 500,000 profit and more from selling real estate, if they operate as a sole proprietorship and don't have any wages paid, like they would with an S corporation, they can literally take themselves out of this wonderful 20% deduction. Number 3, I talk about with kind of a smirk on my face, but it's called the Augusta Rule, everyone. And I was teaching in Augusta, Georgia, a summer ago, and I was really enlightened by a number of realtors in my class, because Augusta, Georgia, obviously is the home of the Masters Tournament, which is just coming up in the next several weeks. And in Augusta, I was surprised that over 1,000 homes, Linda, go on the rental market for people coming in from all over the world to rent properties while they attend the Augusta Masters Tournament. So the rule is this: if you rent out your principal residence or second home for less than 15 days during the year, the rent is tax-free. The rent income is tax-free. And that is pretty cool, everybody, because the average rental for the 7 or 8 days of that Masters tournament is around $15,000. But just assume, just for a second, that Tiger Woods pays $50,000 for a beautiful home of somebody in Augusta for his entourage, and rents it for 7 or 8 days. That $50,000 is tax-free. Now, to the recipient. Now, the offshoot of this, though, and you really need to talk to your accountants about this, is let me just push a little bit. So let me be a little aggressive. So what about your S corporation or your partnership or your LLC paying you rent to use your home for monthly board meetings or quarterly board meetings or shareholders meetings, things like that, which is basically you? And I'm just telling you, everybody, that this is kind of pushing, but there's a private letter ruling back in 1980 that basically, where the IRS chief counsel says, if done right and substantiated correctly, this could be rent paid by your entity, which would be tax deductible, and received by you for renting it less than 15 days, which would be tax free. So I'll guarantee you this: some accountants will be kind of somewhat negative about this, but at least I'm here to point out some planning opportunities. And number 4,
I have a question. I have a question real quick about that, Chris. Chris, can I ask a question about that one?
Sure.
So you're familiar because you guys were a part owner of a KW office at one time, or your wife was, whatever, on how that was. But so let's say, for example, I let my ALCs use it, which I do regularly, or even my church. I let my church use it a lot. Could my business pay for that? Because that's kind of a form of the way I tithe, is to let the church and different women's group and stuff use the house for retreats and meetings and all that stuff. So let's separate the two. Let's use the church and stuff first. If one of my businesses
Linda, let's do this, not to interrupt. Let's stay away from the church and keep it on the business side of it just for a minute.
Okay.
All right.
All right. So
let me just say this about the church side of it. You cannot get a charitable deduction or a business deduction for somebody using your stuff, right? That's always been a denied deduction. So I'd rather stay away from that and stay on the business side. And then if you're going to push me to the church side, I'll try to answer it. But go to the business side of it first.
Okay, so you know how our market centers work. We profit share,
Yep.
So I would definitely not do it above the line. But let's say instead of just let my ALCs and all of them use it as a ALC retreat, the business could pay, and I could pay it below the line. That way I don't affect profit share of my agents and stuff either, right? Would that work with that or no?
Well, again, I'm going to stay away from above the line and below the line, company expense versus non-company expense. But simply put, if you would have your business, all right, pay rent for the use of, for example, the ALC, using your house for their monthly meetings, which would be 12 meetings, which would be less than 15 days. If that would be considered business rental, and I think it probably would be, it would be deductible by your business, Linda, and tax-free to you personally. That's the key.
Okay, and then I could choose whether I take it above or below the line, probably. I mean, definitely.
Well,
below
again,
the line.
I
think
that's not really tax, okay, but that's just Keller Williams accounting.
Yeah. Okay. Got it.
I love
Perfect.
this one,
Right.
you guys, because we just learned about this in our KW Wealth building class also. And it's great, I think, too, for like retreats and stuff, right? I mean, we had a 4-day retreat at our house last year. So I think there's tons of different ways you can use that.
Oh, absolutely. Absolutely. And I know the gentleman who spoke about that in the wealth conference. And I'm just telling you, everybody, that there's a private letter ruling from the IRS that goes all the way back to 1980. And Linda and Dana, I want to give you the number of that. All right. In fact, I've got it right here on my desk. And this would be
interesting and find it.
Me too.
This would be, well, I've been talking about it, so here it is. But the this sets up the authority for it. It is private letter ruling, PLR number 810-4117, dated October 30th of 1980. Again, PLR number 810-4117, dated 10/30 of 1980. So, a private letter ruling is only substantial authority between the IRS and the person who paid for that some 40 years ago. But it also indicates kind of what the thinking of the IRS is. And I would just tell you, Linda and Dana, in my travels, I am meeting more agents in my seminars who have heard of this, Dana, and who are taking advantage of it. So one philosophy very quickly. Don't mess around with income, realtors, but be aggressively legal on your deductions. And I consider this very much aggressively legal. So go for it.
I love that. And, back on the Augusta Rule also, gosh, people have like the Kentucky Derby. They have, cowboy games. They have races. They have something in their city almost everywhere that somebody could think about this Augusta Rule.
Well, I'll go. How about the big one? Super Bowl, Linda? Super Bowl, the Olympics, the All-Star Games, the NBA Finals. Think about the Final Four and the National Basketball Championship, NCAA coming up. People are taking advantage of the Augusta Rule all over the country.
Yep. Love that.
Okay. Now, number 4 is something that Linda's going to have me drill down a little bit more on, but I will tell you that number 4, cost segregation studies are probably the most significant tax write-off potential that I've ever seen in my career. And I shudder to think of the millions of cost segregation studies that have been done in this country that will continue to occur with investors who own large residential complexes and commercial buildings. And again, we'll drill down on this a little bit more. I think Linda's got some questions of you a little bit later. Now, number 5 is something that I've been teaching from the moment I got out of the IRS, and that's the S corporation issue. And the S corporation offers you the ability to limit to some degree your Social Security tax liabilities. But Linda, I know you want me to talk about some of President Biden's plans, and one of those plans in his next tax bill is aimed right at number 5, the S corporation. So I'll hold off my discussion till we get to that future look. But the S corporation, again, is a way to reduce your Social Security tax liability, but it also serves the purpose of increasing number 2 that I've talked about, the 20% qualified business income deduction for the listeners who are high income realtors. And again, everybody 400, 500, 600 and up in gross commission income. Number 6, the 1031 real estate exchange has been probably the one of the hottest items in my entire career in terms of deferring tax on the sale of real estate. And I'm living proof of what happens to you when you don't do one, because I just did my case in my 1040 in the last 2 weeks, and Linda, I had to pay an additional $50,000, give or take, in taxes on the sale of a Tucson property, between $40,000 to the federal government and $5,200 to Arizona and another $5,200 to the state of Illinois. By not doing the 1031 exchange, it cost me an extra $50,000 this year. So the 1031 is a deferral mechanism in combination with some estate planning. My joke is defer, and then pass it on to your heirs. And then all the deferred gain literally goes away, everybody. It's forgiven by the tax code. And that jumps into number 8, everybody. It's called stepped up basis. But the 1031
hang on one second.
Chris. Yeah,
sure.
Yeah, go ahead, Dana.
Please.
I have a quick question. Okay. On your just for people that may not understand this, on your Tucson property, the reason you owed that, is that because you did not own it for 2 years and you made money on it and you sold it before the 2 years was up?
No, this is a great question. Now, why I speak very, you can all, I speak with my hands. So watch my hands, everybody. So we built that property in 2006 for about, $180,000. All right. And Pulte Construction built that for us. And Linda, this will take you back, but the realtor I used was Tim Baker. Linda, remember Tim? All right.
Yeah,
Howard
of course.
Stars. Right now, he's now gone, but he helped me find that property. Now, Dana, over 17 years, we depreciated it down to a nub. All right. And then we sold it for $369,000 on July 15th of 2022. So the biggest killer on the sale of this was the 25% tax you pay on, I'm going to nickname it depreciation recapture, although the real name of it is unrecaptured section 1250 depreciation. We had to pay a 25% tax, basically recapturing all the depreciation we had claimed. So Dana, to answer that question, we held it 16 to 17 years, but we depreciated it down so much over that period of time and then sold at the top of the market. That 25% just came up and bit us big. And before anybody asks, let me tell you this. Why didn't we do a 1031 exchange? Well, one consideration was I didn't want to sell at the top of the market, which I did, and then have to buy at the top of the market somewhere. But the biggest issue was my bride, Kay, went through some very serious medical issues around that time last year, and the taxes were not on my mind at that time. And as you well know, everybody, you have to identify a replacement property within 45 days. You have to close on a replacement property within 180 days. And that just wasn't in the cards for us at that time last year. So, some personal non-tax reasons. And the other one was not wanting to sell high and buy high. But let me tell you what, it certainly made me look twice when I was figuring our taxes, and up popped that $50,000. But I'm going to make a statement, everybody, real quickly, all right? Because sometimes I get people mad at me in seminars when I say this. But when you owe a lot of tax, right, and we pay a lot of tax every year, and I know Linda does, and I know Dana do, smile. Because you had to make a lot of money before you owe a lot of tax. And I'll guarantee you, every year, everybody, I smile. I'm just going to finish this before I let anybody in on this, but I smile with the tax we owe because you got to make a lot of money before you owe a lot of money, and that's only a good thing. And then you never want to pay a dime more than you should, but you should pay what you should. So, Linda, I'll go back to you.
Okay, so we've had hundreds of properties. We're sitting at about 80 single family right now, 34 vacation rentals. And every time we've gone to our tax attorney and said, hey, should we do a 1031 exchange? He'll usually say something, and it's been in the past years. It's not that much. It's not worth it. So I'm assuming that the property maybe wasn't as old, as hadn't had it as long, so we hadn't paid as much depreciation. That would be one thing. And then that's the same problem, like you mentioned, is it's always either you're buying and selling in the same market that you have to do it, and that becomes pretty difficult, especially in a booming market. You don't want to go out and overpay for something.
Exactly. So
when does this thing actually usually work for people? Because I've never used it once, and I've been dying to try and all that stuff. But when do you find that it tends to work out? When maybe early in people's investing career, when they're going to hang on to something forever.
Or if it's that 2-year time frame, right, Chris? Like we've done it because we bought something and flipped it and didn't own it for 2 years.
Well, Dana, I'm not so sure I'm following you on. I think I know where you are with the 2 years, but be a little bit more clear, okay?
Okay. I could be wrong on this, but
like if you got to own it for 2 years so you don't have to pay capital gains, right?
Yes, that's right.
Well, so here's that's what I thought.
Am I saying it right?
Well, let me just
give
you the tax side of it. The 1031, Linda, first of all, this is a good thing to discuss. 1031s are just it's a wonderful tax plan, all right, to defer the gain and defer the tax into the next property. And I've done 5 of these in my career with properties that Kay and I have owned, but we weren't at the top of the market, Linda. So we sold at a reasonable price and we bought at a reasonable price, but we haven't done it at these tremendous high prices that we've seen in the last couple of years. So I've done them and they've worked really well. And I've helped over 100 clients in a 35-year career with the 1031. And they were at different parts of their career, but they weren't in these high appreciation markets either. Now, Dana, back to you. There is no statutory requirement. Now, everybody hear me out on this if you would. There is no statutory requirement as to how long you must have owned the old property, all right? And that's called the relinquished property. And there's no statutory requirement of how long you've got to own the new property called the replacement property. There's no statutory requirement. So what most accountants and most qualified intermediaries have come up with, Dana, and this goes back to you, is we want our clients to have held the old as long as they can, and then to hold the new as long as they can. So then they come up with their own ideas about at least 1 year or at least 2 years. And personally, Dana, I support the 2 years in doing the 1031. I would like my clients to have owned the old at least 2 years and then to own the new for at least 2 years, if that's where you're coming from, Dana, and I think it probably
Got
is.
it. Okay. Thank you. That helps. You know, one thing I just thought about, though, I was just doing the math because I feel like right now before I got on this, I was doing a Zoom on my monthly industry update, which is where, Linda, Jason, and Mark were sharing yesterday about people are getting on like Grant Cardone saying you should only rent, you should not buy right now, and all these things. But if you just take that Tucson property, for instance, you paid $180,000 for it, you sold it for $369,000. And even if you paid $50,000 in the 25%, not counting the depreciation that you got every year, you would have still made almost $140,000 in profit because you owned
so
real
much money.
estate. You held it.
Dana and Linda, if you think I'm lamenting that investment, that was a superb investment.
No.
We walked away with
I think that's
$220,000 in cash, and then had to write a check for $50,000. So we're smiling all the way to the bank.
Yeah. And that's the point I wanted to make, because I think people are getting away from understanding how great of an investment real estate has been and always will be. I mean, that's a great one to even look at as an example of that.
Well, let me just say this. I'm a certified financial planner, among other things, but 75% of my wife's in my portfolio is in investment real estate, and 25% of it is in the stock market. And my stockbroker called me this morning. I didn't even answer his call. I don't even talk to him right now. I got taxes to do. But, conventional wisdom does not support what we believe in, everyone, which is real estate investing. I'm a huge proponent of it. Okay, let me jump into number 7, everybody, very quickly. And this is kind of a forgotten status. The real estate professional status. I've been teaching since 1994. This is a special status. Invest in RPAC. Invest in RPAC. Invest in RPAC. The Realtor Political Action Committee, everybody, fought Congress over this in 1993 and brought the real estate community the real estate professional status. And what this does, now look at my slide, everybody, if you would. In conjunction with number 1, depreciation 179 and bonus depreciation, and number 4, cost segregation studies, a lot of realtors are creating losses on their Schedule E from their rental real estate. So, Lynn, I was in Minnesota this week doing a CRS-RRC course, and I was talking to several realtors in Minnesota, and their GCI was well over $700,000, every one of them. And they showed me their tax returns, Linda, and they were claiming, one of them was claiming $80,000 loss on Schedule E from the rentals. Another was claiming $120,000 of loss on Schedule E, primarily because of number 1 and number 4 on my slide of the top 10 things. They had done cost segregation studies, or their accountant had claimed the 179 in bonus depreciation on what they had put into their rentals. Now, because they qualify as a real estate professional, that entire loss on Schedule E is deductible against their commission income or salaries from their S corporation, whatever. But if that was somebody that did not qualify as a real estate professional, like a doctor, a lawyer, or an airline pilot, they would not be able to write off those big Schedule E losses from number 1 and number 4. They would have to carry those losses over until one of 2 events, until their properties start to show a profit, and then they can absorb those profits against the loss carry forwards. Or when they sell the properties, then they can offset the capital gain on the sale of their properties with those losses they haven't been able to deduct. And I'm telling you, everybody, a lot of accountants, a lot of CPAs and enrolled agents are not familiar with number 7, excuse me, the real estate professional rule, and they should be. So, Linda, every listener should look into the real estate professional rule. It's good. Linda.
I'm going to send this to my CPA.
Oh, very good. Very good.
Real quick question back on the S corporation, because I know that most agents, when they start to, this is what I've heard from the past too. When you make a certain dollar amount, you should need to have a corporation around you. I've heard it was to lessen the amount of audits or something that you get. This is years ago when I started putting in, my McKissick group into an incorporation. But I was always discouraged from doing the S corp, or I don't feel like I've heard the benefits so much of the S corp. And then one time when we had a partnership with someone who had an S corp, it was really difficult for us when we were not a partner, but when we were trying to buy her business. Does any of that make sense? So I know just enough to be dangerous.
There's a lot to your point, but if you're trying to buy a business and somebody is an S corporation, then you'd be buying the stock of that S corporation, and generally that's not as hard, I don't think, as buying the a business that's not a corporation. But I've been advocating, Linda, all the way back to Howard Brinton, when I first got started in this business, the S corporation status. Every real estate client of mine that I'm doing and have done already this year is an S corporation. And the threshold that I generally speak of in my seminars is, somewhere between 70 and 100,000 of GCI. That's where the step off point is. Under 70, forget it. Don't worry about it. Over 100 for sure. And I'm telling you, Linda, so in a class of pretty heavy hitting realtors in Minnesota on Monday of this week, probably 60% of them were S corporations, and some of them were LLCs who elected to be taxed as S corporations. And then some of them are sole proprietors, because you're never going to convince every accountant of the benefits of the S corporation. So, Linda, I don't know why you aren't, but you've had you've had serious discussions with your accountant, and that's all you can do.
Be sure to subscribe for more business strategies and tactics to inspire you to live an abundant real estate life. Don't forget to rate and review so we can bring you the best content. Find this and other valuable information at everythinglifeandrealestate.com.